Deposit insurance stopped the bank run, then paid for a decade of thrift gambling that cost taxpayers $124 billion. This is Unintended Consequences, Episode 96. In March of 1933, Americans queued around the block to yank their savings out of banks that might not open tomorrow. More than 4,000 banks failed that year. Rumor alone could kill the next one down the street. Half a century later, a money broker in New York could wire millions to a Texas savings and loan he had never seen. The advertised rate was a quarter point higher, and every dollar was guaranteed by the United States. One picture is visceral panic. The other is a rate sheet, a wire transfer, and a government promise. Deposit insurance was designed to kill the panic that destroyed thousands of banks. Instead, it taught depositors not to ask questions, and it handed failing thrifts a taxpayer-backed chip with which to gamble. The 1933 picture is why the guarantee was born. The 1980s picture is what the guarantee quietly taught people to stop doing. The Banking Act of 1933, signed by Franklin Roosevelt on June 16th, created the Federal Deposit Insurance Corporation, the FDIC, because the alternative had just been lived in public. Between 1929 and 1933, roughly 9,000 American banks suspended operations. In 1933 alone, more than 4,000 failed. Depositors who got to the window too late lost their money. The rumor of a rumor was enough to finish the next bank down the street. Representative Henry B. Stegall of Alabama had been pushing a federal guarantee for years. His rural constituents had watched local banks vanish. Roosevelt himself had doubts. He worried that a government promise would invite careless banking and, eventually, a raid on the Treasury. The American Bankers Association fought the idea as a subsidy for weak institutions. They were not being frivolous. Those objections were the arguments of people who had watched banks from the inside, and they were thinking about incentives, not just headlines. But in the spring of 1933, the political fact was simpler than the theory. People would not put money back into banks they could not trust, and the payment system of the United States had already stopped. Stegall's rural constituents and that frozen payment system won the argument. Deposit insurance, initially $2,500 per account when the temporary plan took effect on January 1, 1934, was the price of getting deposits to return. A companion fund, the Federal Savings and Loan Insurance Corporation, or FSLIC, followed in 1934 under the National Housing Act. It wrapped the same logic around the thrifts that financed ordinary home loans. The intention was narrow and humane. Stop the run, restore the checking account, let a solvent bank survive a false rumor. It worked, almost immediately, at the thing it was built to do. In 1933, more than 4,000 banks suspended. In 1934, only 61 failed, and just 9 of those were FDIC insured. Deposits flowed back. Coverage was made permanent in the Banking Act of 1935 and raised to $5,000. For the next 4 decades, the American banking system looked, from the sidewalk, almost boring. Failures were few. Premiums were flat. Every insured bank paid the same rate regardless of how it lent, because the whole point was confidence, not a credit rating agency with a government seal. The ceiling crept up with inflation and politics. $10,000 in 1950, $40,000 in 1974, then $100,000 in 1980. Under the Depository Institutions Deregulation and Monetary Control Act. Skeptics had never fully disappeared, including Roosevelt and the American Bankers Association. Economists and some bankers kept repeating the 1933 objection. If depositors do not care, someone else has to, and that someone is the supervisor, who is always late. Those warnings sounded academic while the 363 world of savings and loans still held. Pay 3% on passbook savings, lend at 6% on 30-year mortgages, and be on the golf course by 3. Regulation boxed thrifts into home mortgages, and interest rates stayed tame enough that the moral hazard stayed mostly latent. The insurance funds looked fat. The public remembered the breadlines, not the footnotes. Proponents could point to a genuine, measured victory. The contagious bank run, as Americans had known it, was gone. Then the 1970s broke the box. The guarantee was still there. The watchfulness was not. Inflation and Paul Volcker's Federal Reserve pushed short-term rates toward 20% in 1981. Savings and loans were still stuffed with old fixed-rate mortgages yielding 6 or 8%, while they had to bid for deposits in a market regulation queue could no longer contain. On a market value basis, large parts of the industry were insolvent by the early 1980s. Estimates of the whole ran well into the tens of billions, and some contemporary analyses put the industry's aggregate net worth deeply negative. The straightforward response would have been to close the dead institutions, pay the depositors, and charge the loss to FSLIC. FSLIC did not have the money. Congress did not want the bill, and the industry had friends. So policy ran the other way. The Garn-St. Germain Depository Institutions Act, signed on October 15, 1982, let thrifts load up on commercial real estate, consumer loans, and other assets they had never been staffed to underwrite. California's Nolan Act and Texas's liberal state charters went further. Ronald Reagan called Garn-St. Germain the most important financial legislation in 50 years. It was meant as a life raft. For a thrift that was already broke, it was a lottery ticket bought with insured cash. The victory of 1933 had a mechanism, and the mechanism had a shadow. Once a deposit was insured, the depositor's incentive to distinguish a careful thrift from a reckless one collapsed to a single number, the interest rate. The bank's incentive shifted too. Losses beyond a thin slice of capital belonged to the insurance fund, which is to say, eventually, to the Treasury. What followed was not a mystery of markets so much as a predictable use of other people's guarantees. Insolvent zombie thrifts paid above market rates to attract deposits, then threw the money at acquisition, development, construction loans, raw land, and, in the more adventurous shops, junk bonds. Deposit brokers in New York and elsewhere sliced large sums into $100,000 certificates of deposit, the insurance ceiling, and shopped the nation for the highest yield. No one had to inspect the loan file in Dallas or Irvine. The government had already inspected the ceiling. Vernon Savings and Loan in Texas, run by Don Dixon, became a grim mascot. A French villa, a fleet of aircraft, and a $5,500 teapot. When federal conservators finally walked in, they found a loan book that was almost entirely delinquent. Lincoln Savings, under Charles Keating, grew from a sleepy Orange County thrift into a vehicle for junk bonds and desert real estate. Lincoln Savings also sold uninsured bonds to thousands of mostly elderly customers in its branches. Many of those customers believed the bonds were as safe as the insured certificates advertised a few feet away. Lincoln's failure cost the government on the order of $3 billion. Across Texas, California, Florida, and the Southwest, similar books piled up. Accounting forbearance and regulatory accounting principles let institutions count supervisory goodwill and other fictions as capital, so the zombies could keep growing. Edward Kane and other economists described the result as a put option. Heads, the owners and managers won. Tails, FSLIC paid. By 1987, the FSLIC fund itself was insolvent. In 1988 and 1989, the failures came in waves. From the mid-1980s through the mid-1990s, more than 1,000 thrifts were closed or resolved. The Resolution Trust Corporation, the RTC, created in 1989, would eventually take over hundreds of them and dispose of hundreds of billions of dollars in assets. Much of it was distressed real estate dumped into a weak market. Second-order damage spread through construction employment and local tax bases. A political scandal, the Keating Five, showed how the same guarantee that calmed depositors could be used to buy time from senators. Third order, the cleanup itself tightened credit as surviving institutions and the RTC retrenched, adding weight to the early 1990s downturn. The FDIC later put the taxpayer cost of the savings and loan crisis at roughly $124 billion. Broader tallies that include industry assessments run higher, commonly around $150 billion. The runs of 1933 had been stopped. The bill arrived, with interest, in 1989. Congress did not repeal deposit insurance. It tried, imperfectly, to put the fear back somewhere else. The Financial Institutions Reform, Recovery, and Enforcement Act of 1989, signed by George H.W. Bush, abolished FSLIC, shifted thrift insurance to the FDIC, and created the RTC. It raised capital expectations and restricted some of the wilder asset powers. The Federal Deposit Insurance Corporation Improvement Act of 1991 went further. Risk-based premiums, so riskier banks would pay more. Prompt corrective action, a ladder of mandatory constraints as capital declined. Least cost resolution rules, and tighter limits on brokered deposits for weak institutions. Those tools were a confession that the 1933 design had been incomplete. They were also imperfect. Premiums still lag the risk. Capital ratios can be gamed. Prompt corrective action is only as honest as the accounting. The 2008 crisis revealed that the largest banks carried an implicit guarantee beyond the statutory cap, too big to fail. Coverage was raised to $250,000, first as emergency, then as law. In March of 2023, when Silicon Valley Bank and Signature Bank collapsed, uninsured depositors were protected after all. The theory was that a run on the uninsured would become a run on the system. The safety net widened again, for reasons that would have sounded familiar to Stegall. Panic is expensive, and guarantees are fast. The countermeasures remain. So does the original bargain. A guarantee that removes fear also removes watchfulness, and the watchfulness has to live somewhere. It has to live in premiums that bite, so a reckless book costs more to insure than a careful one. It has to live in capital that is real, not supervisory goodwill and other fictions that let an insolvent firm keep growing. And it has to live in supervisors who close the dead instead of hoping they earn their way out. Incentive structures find their loopholes, especially when the loophole is legal and the loss is socialized. Forbearance is not mercy. It is a loan of public money at a hidden interest rate, and the borrower who is already insolvent will not use it conservatively. Deposit insurance remains one of the great stabilizing inventions of the 20th century. The original bargain is still on the table every time a new class of liabilities looks run-prone. In March of 2023, uninsured depositors at Silicon Valley Bank and Signature Bank were protected to stop a wider run. Coverage had already been lifted to $250,000, and the largest banks already carried an implicit too-big-to-fail promise past the statutory cap. Each widening had a reason that would have sounded familiar in 1933. Panic is expensive, and guarantees are fast. That does not make the reason wrong. It makes the residual question sharper. The next time a regional bank or some new pool of money that people treat like a checking account starts to look run-prone, the crowd will want to be calmed. What would you watch for before that day arrives? Not whether the guarantee gets written. Who, exactly, is still supposed to stay afraid? The customer who no longer inspects the books? The supervisor who arrives late? Or the taxpayer who holds whatever risk is left? That's the case for today. The lessons tend to travel further when you share them, so send this one to someone who'd find it useful, and subscribe wherever you're listening. See you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. One more thing. If you liked today's episode, our sister show, First Principles Daily, is worth a spot in your feed. Reasoning from raw materials, not analogy, on the breakthroughs that actually cut cost. It's one of the NARA Network's daily briefings, all free at naranetwork.com. And on the website, every episode's visuals live in our free image gallery at naranetwork.com/gallery. Royalty-free under Creative Commons, download with attribution. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.